So we will continue our discussion on economy. We have started off with a new module, that is balance of payments, and we have discussed the basic concepts related to balance of payments. Actually, we have discussed what is balance of payments and different accounts of balance of payments, and then we have discussed few concepts like trade account balance, invisible account balance, current account balance, and if it is negative, we have understood it as current account deficit, and then we have talked about capital account balance, and I've actually taken up a balance of payments summary and I've explained everything, and finally I've talked about reserve changes and how Forex will be added and how Forex will be how inflow of Forex and how outflow of Forex could be understood from balance of payment. All these things we have discussed. We have also discussed about balance of payment equilibrium, balance of payment, BoP surplus, BoP deficit, and all these concepts. Okay, so in this session I will be talking about one of the most important aspect, and if you remember in the last video towards the end I have told you balance of payment summary, that is not enough to understand the actual economic situation. There are many other indicators also which has to be taken into consideration. So here in this session I'll be talking about some of the indicators of balance of payment situation, and then we will also have a short discussion on Forex Reserve, and I'll tell you the change in Forex Reserve, how this can happen, and then we will discuss about the advantages of holding a huge Forex Reserve. I'll also discuss certain concepts like debt service ratio, sovereign wealth fund, and all these things will be covered in this particular session. So I'll take 2 minutes. I'll go for a quick recap of what all things we have done. We'll briefly talk about what we have discussed before. Let me discuss about balance of payment first. Okay, I'll just talk about the different accounts in balance of payment. So BoP, and as we have discussed, we have current account, all the export, import, and all those things will come here, and then we have capital account. So here the change in assets and liability will come. Then the current account is actually divided into two: trade account, or it can also be called as visible account or merchandise account, because when you're talking about trade account, I am talking about exports of goods and imports of goods, not services here, and that is the reason why we are calling or we are talking about visible account. Only goods are coming here, so that also you can write here: export of goods and import of goods. Okay, then the other one will be invisible account. So this is visible account or merchandise account. So there I will be talking about services because that is invisible. Okay, so here invisible account, here I have export of services and import of services, so we can write it together: export or import of services. So export slash import of services, and one more component is there, that is current transfer, so which involves the transfer receipts which we receive and the transfer payments, or basically these are foreign remittances in the form of gift, grants, etc. Okay, and I have told you we are one of the largest receiver of foreign remittances. Okay, so these are the things which comes under current account. Then in capital account, what all things we have discussed? We have discussed about foreign investment. We have discussed two major foreign investment as FDI and foreign direct investment, and portfolio investment, PFI, and then we have talked about ECB, external commercial borrowing, when the private companies are borrowing from abroad, and then we have discussed about NRI deposits, and I have told you this forms part of external debt. Okay, so NRI deposits. Then we will be writing about external assistance here. External assistance, when we talk about external assistance, I'll be only adding loans here. Okay, I will not be adding grants which we receive here because it was already added in the current account. Here when we talked about current transfers, I told you the gift, grants, and such foreign remittances will be added over there. So when we talk about external assistance, only loans. Okay, and then one more component is sale or purchase of assets. Okay, so if an Indian is buying an asset abroad, or if some Indian is selling assets abroad, all these things will actually be added to the balance of payment. So this is your two accounts, current account, and then we have a capital account. So current account, trade account, and invisible account. So I hope you understood this. Now we need to talk about 2-3 concepts. That trade account balance. So when you talk about trade account balance, you can see this is trade account. So when you talk about trade account balance, it's actually export minus import. That's it. Nothing more to discuss over there. Export minus import, and it is implicitly it is clear that I'm talking only about goods. Okay. So when I talk about trade account balance, it is export of goods minus import of goods. What about invisible account balance? So you need to see what are there in invisible account. So here you have export minus import of services will come, but at the same time when you take export, that you're receiving money, right? There is an inflow of forex. Similarly, from current transfer, you will actually add transfer receipts. That is also inflow of forex. So on one side, it is the export of services plus the transfer receipts minus import of goods, import of services because outflow of money, plus transfer payments, that is also outflow of money. So export of services plus transfer receipts minus import of services plus transfer payments. Okay, so I think I have written it before somewhere here. You can see here. So this is trade account balance, export minus import, and I have given you a lot of data and we have discussed this in detail, and I've told you if it is negative, it is what we call as trade deficit. Okay, and we have this problem of trade deficit. We had actually minus 130. All those things we have discussed. You can see invisible account means export of services plus current transfer receipts minus import of services plus transfer payments, as we have discussed. What about current account balance? It is actually current account comprised of what? You can see here, current account comprised of both trade account as well as invisible account. So what we need to do? We need to add both. Okay, so you will see here, you can see here, export of goods and services plus transfer receipts, these are inflow, minus import of goods and services plus transfer payments, these are outflow. Okay, so when you take the difference, you will get the current account balance, and it should be positive, but in India's case it is actually negative. And I have told you if it is negative, we will also call it as current account deficits. Okay, similarly we have seen capital account balance, that is nothing but capital receipts minus capital payments. All these things we have discussed, and then I have talked about, you see this balance of payments summary. So you can go back to the previous video and you can watch this. Everything is actually cleared with perfect data. And then I've told you about reserve change, how forex is added, or inflow of forex and outflow of forex. What is this concept of negative? Negative means inflow of forex and positive means outflow of forex. You don't want to have confusion, and I have made that confusion very clear in the previous video. And then we have talked about these concepts: BoP equilibrium, BoP surplus, BoP deficit. So this is what we have done so far, and now today's session I'll be talking about indicators of balance of payment. If you have any doubt in any of the videos that we have done so far, you can get in touch with me. This is my Instagram ID and this is my Telegram channel. So you can join the Telegram channel to get all the videos. I have done history, around hundreds of videos I have done. Economy I have done around 70 to 80 videos so far. Around 6-7 modules we have completed, which is very much important for your UPSC prelims as well as mains. Each and every topic from the syllabus is actually covered without missing anything. You just need to follow the class, and you don't want to read any other textbook. Okay, but maybe for the current data, you need to just refer to the newspaper or economic survey. Apart from that, from concept side, it is complete in itself. You don't want to read anything apart from the class that we are providing. And I've done around hundreds of this quantitative aptitude, mental ability videos also. But that is as part of CAT, which is at a very higher level. But obviously you can get all these videos in this Telegram channel or in StudyIQ only. Every videos I've done in StudyIQ only. So this is my Instagram channel, the Instagram page, and you can get connected to me. This is my Telegram channel. So let's get started with today's session. We'll start off with indicators of balance of payment situation. So indicators of BoP situation. So the first one and the most important one is actually Forex Reserves. I'll tell you what is Forex Reserves and what are the components in Forex Reserve after completing this one. So the first one I'm writing it as Forex Reserve. And if you remember in our one of the video in planning module, we have discussed about the 1991 situation that we have gone through BoP crisis. BoP crisis is nothing but the shortage of Forex. So in 1991, we faced this acute severe problem of shortage of Forex, and we didn't even had, $1 billion to pay 1 week of import bill, and we suffered a lot. Even World Bank was not ready to help us, and they have asked to pledge gold to fund us. And then later, under Washington Consensus in 1991 that we have signed between IMF and World Bank, we have to follow certain conditions, and then we went for LPG reforms. That was what we understood as the first generation reforms, and then we have also talked about second generation reform when the BJP government came to power later. Okay, and all those things we have already done, so we went for reforms, and the problem is actually solved. So here when we talk about Forex Reserve, it is actually not required for you to remember what exactly is the Forex Reserve. The rough idea is enough because it changes daily basis, right? The inflow of Forex and outflow of Forex, it changes daily basis. So if it is, let's say, $350 billion, suppose if it is $350 billion, again, it will keep on changing, so you don't want to remember this particular number. So now the question is this enough, or what is the adequate Forex which is required? Or 300 billion is enough, or 250 billion is enough, or 400 billion is required? So there's a question, right? Now, what I want to tell you is there is no concrete rule for this. Adequacy of Forex is actually relative, and it depends on the country, depends on the size of the country, depends on what? How much you need to pay to rest of the world, right? So, and most of the payment is actually through trade. So more the import, more Forex is actually required, because most of your Forex outflow is for paying the trade bill. Okay, so what I want to tell you is, if you take India, when I'm talking about 300 billion, it may be required because we have a bigger economy, huge economy, and we have huge import, so we may need this much. But if you take Nepal is a very small country, their import may be minimum, so they don't want this much, right? So if I'm talking about a very small country, they don't have any imports, or if they have limited import, they don't want to have this much Forex that what we need. Even if you talk about a larger, bigger country, but if they don't have any connection with outside world, rest of the world, there is no much imports, they also don't want to hold huge Forex because they're not supposed to pay any bills. Okay, so it all depends on, it is relative. What I want to tell you is Forex is relative, but we are understanding it in terms of imports. So what is the actual adequate Forex is? The adequate Forex will be, which it should be more than 6 months of your imports. Okay, so adequate Forex will be greater than 6 months of imports. So actually import cover is used to check the adequacy of Forex. So the reason is major outflow of Forex will be to pay the import bill. Okay, and I've told you, even if the country is larger, if there is no import, there is no need to have that much Forex. So everything is understood in terms of trade. More the trade, more the Forex is actually required. Okay. Now, one important point that I want to tell you, which is important from prelims point of view, is actually the Forex is consistently increasing from 1991. In India's case, it is consistently increasing from 1991 because they used to ask this kind of question. GDP was consistently increasing from 2005, 2008, 2011, like that. So Forex was consistently increasing from 1991. Why I'm taking 1991? Because 1991 we have already discussed the BoP crisis and Forex shortage and LPG, all those things we have done. But in some years, in 3-4 years, there were some marginal fall. But apart from that, in general, you can understand it as like from 1991, actually the Forex is consistently increasing. So that's about the first indicator. Second one is current account balance, or in India's case it is always deficit. It is negative, so we call it as deficit. So I'll be writing it as deficit. Okay, so current account deficit. I'm not writing it completely, current account deficit, and we have already discussed that in 2015-16 value that you can update, obviously, $22 billion. If I'm talking about current account balance, I would say minus $22 billion. That's the difference. Okay. Now, what is the adequate current account deficit, or I won't say adequate, what is actually the desirable, or to what extent you can go in terms of current account deficit. like what I have told you in case of Forex Reserve, current account deficit is also again relative. Okay, so it depends on what? It depends on, earlier it was completely depending on trade when I'm talking about Forex, because major outflow of Forex is in terms of trade, and when I'm talking about current account deficit, it is relative, and we will always try to understand it in terms of GDP. What percentage of GDP? Okay, so here, now if you see, this was the data of 2015-16, so I'll give you the GDP of 2016. So GDP 2016, okay, this was 160 lakh crore. Okay, so 160 lakh crore, it was in rupees. So what we need to do, we have this in dollar. What I can do is I can convert this into dollar. Now there are two ways in which you can convert. Either you can go for market rate of dollar, or you can go for purchasing power rate actually. So both are exchange rates only. One is market rate, let's say 67 rupee, and one is purchasing power parity based rate, that is around 18 rupee. What is this difference between these two we have already discussed, but quickly I'll tell you. Purchasing power, market rate means what? It will be always higher. The problem is market rate won't show you or give you the actual value of dollar or actual value of money. Okay, the reason is, we all know dollar is a hard currency, so demand for hard currency is always very high. So in market, the rates are decided on the basis of demand and supply, so the price is actually going high when the demand is more. So market rate will not give you the actual real worth of dollar. But if you see purchasing power rate, how it is calculated, it's like this only. You spend $1 in US, how much items you can buy. That means by spending $1, what all items you buy over there, to get the same items in India, how much rupee you need to spend. So that is what purchasing power. That shows the real value of money. Those items which you bought in US, like Pepsi or mobile phone or this MacD, these common items is what I'm talking about. You spend $1 over there, to get those items, how much you need to spend here? You need to spend 18 rupee here. Okay, so that actually shows the real comparison and the real value of rupee or dollar. Market rate won't show you. So for the comparison purpose, it is always purchasing power is taken, and that's why when I'm talking about the economy, size of economy, India's third largest, not in terms of if you calculate at market rate. If you calculate at market rate, actually GDP will come down. If you calculate at purchasing power, you see that when you're dividing, denominator is low because it is 18 rupee, so our GDP, the volume will be higher. I'll show you here. So 160 lakh crore, what you can do is you can divide either by using 67. So if you go for market rate, it will be 160 lakh crore. When you divide, you'll be getting around 2.25 trillion. Okay, and if you divide it 18 rupee, so this is 67. If you divide it purchasing power parity rate, that is 18, you see 67 is around there is a 4 times or close to 3.5 times difference is there. So denominator is low, so obviously the GDP will increase, so it will be like around 8.75 trillion dollar. So you can see, as per purchasing power, the volume is higher, and that's why I've told you third largest economy in terms of purchasing power. But when it comes to market rate, we are around 7-8. That is our position. You can see here the difference. Okay, so here I'm talking about market rate only. So here we have seen 22 billion and 2.25 trillion. So what percentage of 2.25 trillion is 22 billion? That comes around 1.1 percentage. So what is our current account deficit if you express that in terms of GDP? 1.1 percentage of GDP. Okay, so I just want to tell you how it is actually calculated. So 1.1 percentage of GDP, and what is the desirable situation, or what is the adequate CAD, or I won't say adequate like in terms of Forex, I should say what is a comfort zone. That means to what extent you can go. The comfort zone is actually it should be less than 2 to 3 percentage of GDP. So we are very much in the comfort zone. The next is again very important concept, third component, that is external debt. Okay, external debt. And if you again talk about 2016, September 2016, external debt was around $483 billion, which was close to 23.4 exact value, close to 24% of GDP. Okay, So it was around 24% of GDP or external debt. Now, I've told you already what you mean by external debt, right? It is not only the debt of government, it is actually the debt of the country. Debt of the country means both private as well as government. The private borrowing will also be part of external debt, okay? So it is the debt on entire country, not the debt on government. Debt on government is actually public debt, okay? So here I'm talking about external debt. So private and public will be there. Out of this, what do you think the contribution, whose contribution will be more? In external debt, actually private contribution is more because of all these ECBs and all. So it is around 80% and public will be 20%, okay? What are the sources of external debt? Sources, as we have already discussed, firstly external commercial borrowing, and then we have NRI deposits, and then multilateral borrowings. All these are multilateral borrowings. All these are actually sources of multilateral borrowing means IMF, World Bank, etc. All these are sources of external debt. And one interesting fact which I want to tell you is this external debt. So I'm just deviating and I'm talking about public debt. Public debt means debt on government. Public debt. You know, this is debt on government. So this is debt on entire country. So from outside, debt on entire country from outside, okay? So what do you think, which one will be more? Actually, public debt is more. It is around 67% of GDP. The reason is the public debt involve the debt of government from domestic sources also, and that is very huge, okay? So that will also be added, and external debt from government side will be added, not the private side. So that is why it is around 67% of GDP. That is around 3 times, close to 3 times of external debt, okay? So debt from India also is part of public debt, but when I'm talking about external debt, it is just the debt from outside, okay? So in that, government is having some 20% only. That 20% will also be part of this, obviously, but out of the 67, that 20% will come plus whatever the government is borrowing from India also will be a part of it. So I hope you understood the difference between external debt and public debt. External debt is the debt on entire country, private as well as government, and from outside only. Public debt means debt of government from outside as well as India, okay? And this is 67%, close to 3 times. You need to have a rough idea about this. Now let's quickly talk about this ECB. We have already discussed about ECB. These are private borrowings, okay? Now in this, it can be short term, it can be long term. All these we have discussed. So short term is around 25% and long term is around 75%. I've already told you ECB is not too much desirable, maybe desirable to an extent, but after that it is actually going to create problem. Although it is giving you funds and money and development of infrastructure in all these way at the initial stage of developments, it is actually going to help you for a developing country like India. But the problem is, you need to pay back this with interest, and from where this interest is going? Interest is actually going from the current account. I have already demonstrated, I think I have shown that here. You can see here. You see here, when I talked about services, there are factor and non-factor. When you talked about factor inputs, land, labor, capital, entrepreneurship, right? So in that, I have already told you here, you can see that the capital, for the capital, you need to pay interest from here, and this is part of current account. So when you are paying interest for this external commercial borrowings or the foreign assistance, what is actually happening? You are paying it from the current account. So in long term, the current account deficit is actually increasing, and that is not desirable, okay? So both are actually bad, but which one is worst? Short term is worst because you need to pay back immediately. Long term, you may get some time, but even then there are problem because interest is paid from current account. You just need to have all these idea, and I'm making it very clear. There is no need to have any confusion. If you start reading the textbooks, it will take a lot of time for you to understand these concepts, okay? Now one more interesting fact which I want to give you here is international debt statistics, which was published by World Bank in 2017. International debt statistics 2017 by World Bank. You know what was India's position? India was the 5th largest debtor. 5th largest debtor in the world was India. Okay, and they have given the classification severely indebted based on the vulnerability. Okay, moderately indebted and less indebted. So these three classifications are given on the basis of vulnerability, and I've already told you India is the fifth largest debtor, so you can make an assumption, you can make a guess here where India will come, and that guess will be wrong because India is actually coming here in less indebted. The reason is debt and indebtedness is different. Okay, so I've already told you India is having $483 billion external debt. Now if you take Nepal, even if let's say $400 million is their debt, okay, so I would say Nepal is, see, obviously you can see if you talk about debtor, it is India who is the largest debtor here, there is no doubt in that. But if you talk about indebtedness, this is again relative. There's a relative concept. India is having capacity to repay this debt. We are a largest economy, one of the largest economy, and we are in a position to pay this, but Nepal may not be able to pay this. Okay, we are the third largest economy, as I have already told you. So Nepal may be more indebted in this case, and that is the reason why, although India is the fifth largest debtor of the world, but we are classified under the less indebted because we have that capability to repay the debt. And you know, in 1991 we are having 28.5% of GDP as the external debt. Now it was reduced to 23.4%, and that is actually a good sign only. One more concept which is related to this debt that I want to discuss is debt service ratio. So debt service ratio, what is this? In the numerator, payment of interest and principal on external debt. So you need to pay the interest and the principal divided by current account receipts, whatever you receive. Okay, current account receipts, and if you need to get it in percentage, you have to multiply by 100. And you know what is the value of India? It was 7.5. What do you mean by that? You need to spend 7.5 to pay interest and the principal on external debt out of every $100 that you're receiving. So 7.5 you need to spend out of every $100, and it is actually a very reasonable value, and that is why this debt service ratio is actually an indicator of indebtedness. Okay, so we don't want to spend too much. 7.5% is actually a reasonable value. You know what was our debt service ratio in 1991? 1991 it was 36%. What do you mean by that? Out of every $100 that you are getting, $36 you have to spend for paying the interest and the principal. So now the condition is much better. Now I'll give you a brief idea about, you know, the composition of capital flows. Okay, now and before. So composition of capital flows. Okay, so there are two types: non-debt capital, then the debt capital. Non-debt means that these are investments, it is coming as investment. Debt means the capital which is coming in terms of ECB loans, etc., foreign assistance, like that. Okay, so I'm talking about 1990s and I'll be talking about now. Now means last 3-4 years. Okay, so 1990s it was 15% which was coming from non-debt category, that means as investment, and 85% was debt. Okay, now you know the trend changed. It is 70% non-debt, that means it is coming as investment, and 30% is the debt, that means in terms of loans and grants. So you can see the change in trend here. Before it was in terms of loans, which was very high, and investment was very low. Now after LPG, this is one of the most important impact of, you know, LPG, because you have a topic, effect of liberalization on Indian economy, in your UPSC mains in the third chapter, in the third paper. Okay, so this is one of the impact that this data you can remember, and you can obviously write this one. Anyway, I'm going to take that after this, towards the end of this, impact of liberalization of on Indian economy. Each and every topic from third chapter I'm covering here. Similarly, history also. Okay, so now what is the conclusion? The overall BoP situation is actually strong, but not very strong. But we have, what is the advantages of having a very strong BoP situation? Because if your external balance is strong, you can recover or you can be resilient from any external shock, and that's the reason why we could recover from that 2008 global financial crisis. Okay, so now the question is, do you support liberalization? You obviously need to support liberalization, but you have to take into consideration the BoP situation. For any country at the developing stage, liberalization is actually good because you get a lot of fund, infrastructure, investment and all these things. But the problem is the vulnerability. It is coming up with a huge risk. And if you can accommodate that risk, how can you accommodate the risk? If your balance of payment situation is very strong, you can absorb any external shock. So if your BoP situation is strong, go with liberalization. If your BoP situation is weak, you have to stay away from liberalization because you can't absorb the external shock. So that has to be very clear. So instead, what you can do, you can go for promotion of Make in India and all those things, increase exports, increase investment, efficiency, increase productivity, increase, and all those things can be done. Okay, so that's about indicators of BoP. Let's quickly now talk about Forex Reserve. Okay, so Forex Reserve. What are the components? You have mostly hard currencies in terms of dollar, pound, yen, renminbi, etc. Okay, so dollar. Then you have gold. Okay, and then you have SDR and RTP. What do you mean by SDR? SDR is the special drawing rights, and RTP is the reserve trench position with IMF. Okay, so what is the proportion? Maximum you hold it in terms of hard currency, 94%, and this is around 5%, and this is the least one, that is around 1%. Okay, so that's about your the components of Forex. Now let's talk about change in Forex. So how Forex is actually changing, or how can you understand the change? So first one is obviously, as I have discussed, BoP effect. Okay, so if there is a change in hard currency because of change in quantity of hard currency, how this is actually happening, we have discussed it here. You can see here, overall balance is 18, so reserve changes minus 18. Minus 18 means inflow of $18 billion. So this is how hard currency is changing. So that lead to increase in Forex, so that lead to change in Forex. Second is, even if there is no increase or change in this way, there may be some valuation effect. So you need to know this. They can ask this as a prelims question. While valuation effect means it is actually happening because of the appreciation or depreciation of dollar against, not rupee, against other hard currency, because rupee is not part of your Forex. Okay, against other hard currencies which are part of Forex, like euro or pound, renminbi, and etc. Okay, other hard currencies. Now if you have any doubt, I'll explain this. For example, let's take, you have $1 and £1 in your Forex basket. Okay, so if you express this in terms of dollar, how much dollar is there in total as your Forex? You can see €1 is around $1.3, if let's suppose. So $1 and $1.3. €1 is $1.3. So effectively you can write it as $2.3 as your Forex. Now imagine a situation that dollar appreciated. So what will happen with €1 now? Dollar appreciated means $1.2 now. So €1 is actually equal to $1.2. Dollar appreciated. Now if you see, there is $1 and €1 means $1.2. So what will happen? $2.2. So that means your Forex is actually reduced. Even earlier also $1 and €1, now also $1 and €1. Why it is reduced? Because dollar appreciated against euro or pound. Okay, so this is what you mean by appreciation or now if it is depreciation, $1, if it became $1.4, then what happened? Your Forex would have increased $2.4. From 2.3 it would have been 2.4. Here there is a decrease because dollar appreciated. If dollar depreciate, your Forex will increase. Okay, so this is what you mean by valuation effect. So I hope this is clear for all of you, and I hope you also understood why other countries are not keeping rupee in their forex, right? Before, if you remember, in 2013-14 time, it was 45 rupee per dollar. Now it is around 67-70 rupee. So when rupee is depreciating or dollar is appreciating, you understood what is actually going to happen with their forex. So whatever they are doing is actually correct only. Okay, so I hope that is clear. Now let's also talk about the advantages of holding huge forex. So what are the advantages of holding huge forex? It will strengthen BoP. Secondly, it will increase resilience against any external shock. Increase resilience against external shocks. And you can invest this in foreign securities also, because if you invest, you may get some interest, and that interest can be used for some other purpose. So maybe invested in foreign securities. Okay, and you can use this to pay your external debt. If you can use that to pay your external debt, your interest burden will actually come down. So current account deficit can come down. So maybe used to repay external debt. So the interest burden will come down, current account deficit will reduce, and also may be used to import. Why you need import? If there is a problem or demand supply mismatch in the domestic items, you can import. In case of onion, you can import. If you have a huge forex, you can actually import so that you can tackle inflation. Import to reduce inflation. Okay, and you can also use this to import capital, infrastructure, etc. So you can use to import capital goods, infrastructure, etc. Okay, so you can't keep this forex idle. There is a huge opportunity cost involved in that, so you can do all these things. Now one more concept which I want to discuss is sovereign wealth fund. Sovereign wealth fund. Sovereign wealth fund means a part of your forex you can keep it aside, and this corpus, this is what you call as corpus, and this may be invested in the foreign securities. As I've discussed already, China is having a huge sovereign wealth fund, and they invest in almost all the US securities, and half of US external debt is basically connected to China. So let me write it down. So consist of part of forex reserve of a country, and its corpus is invested in foreign securities. Okay, so I hope this is clear for all of you. If you have any doubt, you can get in touch with me. This is my Instagram ID. You can join the Telegram channel. So you can join this Telegram channel for all the videos, any mentorship, any test series. I teach sociology also. So you can get in touch with me. I hope you understood the session. We will complete the session in 2 more lectures. So everything related to BoP, which is there in our syllabus, will be covered. So if you see the modules that we are taking, I may take around 5-6 sessions for each module.